How often than not, we as a mutual fund distributor struggle to select the right mutual fund scheme, especially in the debt space for our client. And in this video, I'm going to share with you 5 simple ratios which you can be using to select the right debt mutual fund scheme for your client. And these ratios and these informations are available in public so that you can take an informed call. Hello everyone, I'm Shobhit. I'm a Fin-based growth expert and founder of Fin-based Growth Club. We are an aspiring community of new age distributors who are determined to change how India invests. So what are the 5 ratios which you should be very particular about when you are choosing a debt mutual fund scheme for your client? So the first ratio which I want you guys to look into, understand is meaning what it is going to help you in understanding about the portfolio is average maturity. So before diving into the technical aspect, let's understand what maturity means. Maturity means the time when you are going to get the principal back from the company where the fund or the scheme has invested. So any debt instrument will have 2 parts. One is the coupon or interest, which it is going to pay on a periodic basis. Then it is going to promise that they are going to return the principal after the promised date. So it can be after 5 years, 3 years, 2 years. So the year after which they are going to return the principal, it is called the maturity date. So what we mean by average maturity? Average maturity is nothing but understanding the maturity profile of a debt mutual fund scheme. And how we are going to calculate? Let me give you a simple example. So it is a weighted average which we are going to calculate when we are talking about average maturity. Now in this example, I have taken a portfolio which is having 4 schemes or 4 securities to be precise. And in security 1, the fund manager invested say 50 crore rupees and the maturity is 7 years. A B security is fund manager invested 45 crores and 3 years is the maturity when the fund manager is going to get his money back. Same way C and D. So how we are going to calculate the average maturity? As it is a weighted average, then I am going to multiply the amount with the year and then I am going to divide with the total amount which the fund or scheme has invested. So here the average maturity comes at 4.36 years. This means on average the portfolio is going to mature in 4.3 years. Some securities going to mature before that, some securities are going to mature after that. But on average, the portfolio is going to mature in this time period, provided the fund manager don't buy or sell any security in the portfolio which they are holding. But generally it is not the case. But average maturity number which you are going to see in a fact sheet or various debt schemes communication, it is going to help you understand how sensitive the portfolio is in terms of changing the interest rate in the market. If the portfolio is having higher maturity, then any movement of interest rate which is going to happen in the market, it is going to impact the value of the portfolio to a larger extent. Lower the maturity, lower will be the sensitivity. Now, important thing which you need to understand is how average maturity is going to help you in selecting the right mutual fund scheme. It is going to help you in a manner that whenever you are investing in any debt mutual fund scheme, first you need to know the time period for which the investor is going to invest. So suppose investor wants to invest for say 2 years. Ideally, you should be picking a mutual fund scheme which is going to be having an average maturity of 2 years or so. If your client or you are allocating investment into that mutual fund scheme for your client which is going to be invested for say 5 years, ideally you should be investing in those schemes which is having a maturity profile of 5 years. And the recent classification of debt schemes according to the maturity profile of the securities which these schemes are going to hold, it is going to help you in selecting the right mutual fund scheme. So in case you don't know, let me share some insights. If you see, all the liquid funds by default should be having should be having a maturity profile of up to 91 days. So in case you want to have an allocation in a debt scheme where the client is expecting to withdraw the money less than 45 days to 90 days, then liquid funds are the good fund to be in. Okay, then money market instruments, they will have a maturity profile of 1 to 3 months. Ultra short term funds will have a maturity profile of say 3 months or more. Now duration funds will have a maturity profile of 3 months to 6 months. So you can find the maturity profile of various schemes here, and this is going to give you indication. The short duration fund will have a maturity profile between 1 year to 3 years. Now this means what? This means that it is going to give you an indication that if I am allocating a money from my investor who is going to be investing for say 1 year time period, which kind of a scheme should be a yes and which kind of a scheme should be a no. It is going to give you a clarity that which kind of schemes you need to be choosing. Now these are the broader parameters: 1 to 3 years, 6 to 12 months. Whenever you are taking any selection of the scheme call, you should be watching at that time period what is the average maturity of that scheme, so that you are able to get the right mutual fund scheme for your client. Now please understand, when you are investing according to the market situation, according to the interest rate movement in the market, the maturity profile of those investment would be determined as the securities the fund manager is going to buy. But in future it may change. That's why if you are taking an investment call, you should be looking at the broader definition first. Let's say if you are investing in a low duration fund manager cannot or fund manager will be having this aspect in mind, that a low duration fund should have a modified duration of 6 months to 12 months. That's all. So he will not be going over aggressive in the portfolio. So you have a clear cut idea that how it is going to work out. So I hope this is going to give you some clarity as how you should be selecting a mutual fund scheme and what average maturity means. Once you are clear in this, the next number which I want you guys to look into it is you should be looking at the credit risk which the fund is going to be taking. Now what credit risk means? Credit risk is nothing but the chances of default by the company in which a scheme has invested, either of non-payment of principal or interest. So if money doesn't come back, forget about the return, your capital will also be eroded. So whenever you are taking a call to invest in any debt schemes, you should be looking at the credit profile of the scheme. Let me share with you some of the some screenshot of some of the schemes. So if you look at I have taken a screenshot of one of the SBI schemes. So here if you see the right hand side, you will be able to find AAA rated paper, how much the fund has invested. It is 27.84%. The below AA it is 20.1%. So the lower the rating, the more riskier the portfolio would be. So whenever you want to select a scheme, you should be very mindful of the profile of the securities in which the fund has invested. If the fund has invested heavily into a lower rated paper like a single A or B or C, you should be very vigilant of that. Even though the YTM would have been very high, but it is going to have a very high impact on the capital erosion if any securities default. On the right hand side, you can see where the fund has invested from a issuer perspective, and you are going to find that it is going to help you in making informed decision. Please understand, debt is investments are not for alpha generation in the portfolio. Debt investments are going to be helping you in stabilizing the returns and capital in the portfolio. So whenever you're doing any debt investments, you need to keep in mind that always go for those portfolio where credit risk is minimized and fund manager is known for not taking undue credit risk. So this is the second number which I want you guys to be very, very particular of, because debt investments credit risk is going to play a very vital role. The third number which I want you guys to understand and look into is yield to maturity or YTM. Now what YTM means? What YTM means the total benefit which the fund is going to get when he is investing in a security. Now what I mean by that, let me share with you some insight. So our YTM is comprised of the coupon or the interest which the scheme is going to receive when they are investing in any security. Besides that, the capital appreciation is happening. Now, capital appreciation means if a fund manager has bought a security for say 100 rupees, and when he is going to sell that security in the market for 110 rupees, then that 10 rupees is the capital appreciation. Now, how in a debt scheme capital appreciation is happening? It is going to happen based upon the movement of interest rate in the market. So what you need to understand, if the total benefit or security is going to generate when a debt fund manager is going to invest in any security is the interest which he is going to receive and the capital appreciation which is going to happen. These are going to play out only till if the fund manager is going to hold that till the maturity. Now this means what? This means that suppose the YTM of a scheme is say 6.36. Now this means if you are going to be holding that securities till the average maturity, you can expect that kind of yield from the investment. Now yield is different from the coupon. Coupon is the only interest payment which you are going to receive. But yield is the amalgamation or the combination of the coupon as well as the capital appreciation which is going to be happening in the portfolio. Now in a layman terms, what it means? In the layman term, this means that higher the YTM, higher is the risk in the portfolio. Let's understand with a simple example. Now, if you are going to be doing a bank fixed deposit in SBI and a bank fixed deposit in say Jana Small Finance Bank, which is going to give you higher interest? The answer is obvious. It is Jana Small Finance Bank. Why? Because the default by a Jana Finance Bank is perceived to be higher than what the SBI default risk would be. And because of that, SBI is going to offer you a lower interest rate compared to your any small or new age banks. Same way, if a YTM of a portfolio is high, this means fund manager has invested in those securities where the credit ratings are low, where chances of defaults are high, and that's why those companies are offering higher interest rates. So you should be very mindful of that, what kind of risk you are ready or willing to take. Higher the YTM, higher would be the risk. Now, it doesn't mean that we should not be aspiring for a portfolio which is showing me higher YTM. We should be doing that. But for that, you need to be very mindful of that. Don't take undue necessary risk when you are selecting a scheme for your client based upon the YTM. So now let me give you some examples. So I've taken a screenshot of say ICICI, one of the debt scheme. So if you see here, the YTM is 6.76%. Now this means what? The average maturity period of this scheme is 2.65 years. So in a layman terms language, if you are going to invest in that scheme for 2.65 years, then you can expect 6.76 annual return from that portfolio. Now, as I told you in the beginning, what is going to happen every month, every situation changing in the debt market, the average maturity and YTMs will keep on changing because the fund manager is going to buy or sell securities in the market. But when you are going to invest, it is going to give you some indication that what it is going to help you with. If you look at this is the SPI, one of the scheme screenshot I have taken. Here you can see the YTM is 6.47 and average maturity is 2.22 years. So this way you need to interpret what YTM means. YTM is the total benefit which you are going to receive when any investment has been done in that portfolio. So the total benefit means the interest which the securities are going to pay into the portfolio and the capital appreciation or the movement of prices of the security which is going to happen. So please keep in mind when you are selecting a scheme based upon YTM, you should not be going very aggressive on YTM front. You should be looking at the quality of the portfolio as well. Now, let's understand modified duration. What is modified duration? Modified duration is going to tell you what is the sensitivity of the movement of NAV depending upon the movement of interest rate in the market. So modified duration is going to quantify what is the percentage of movement which is going to happen in NAV if the interest rate in the market is going to move up or down. The most important thing which you need to understand is the movement of prices or NAV of a portfolio is inversely proportional to the interest rate movement in the market. This means what? If the interest rate in the market is going to go up, the NAV is going to come down. If the interest rate in the market is going to come down, the NAV is going to go up. But what is the quantity or what is the percentage of by which the NAV is going to go up or go down? It is going to be determined by the modified duration. Now let me give you some number. Let's assume that our portfolio is having a modified duration of say 5. And let's assume that the interest rate in the market is going to go down by say 1%. It means the price or NAV is going to go up by go up. But what is the percentage by which it is going to go up? It is going to go up by 5 into 1, that is 5%. So by 5%, the NAV of the scheme is going to go up. So modified duration should be interpreted like this. It is going to give you a clear-cut picture how the NAV of the scheme is going to behave if the interest rate is going to go up or down in the market. I hope this is going to clarify you how you are going to be reading the modified duration number in a debt portfolio. And the last aspect which I would like to discuss with you is you need to be very, very mindful of the track record of the scheme. So fund lineage is also very, very important. How big the scheme is, how long that scheme has been into the market, if there is any history of credit default by the AMC. These all things you need to be very mindful of, because any credit event, any default happening in the portfolio, it is going to impact the portfolio on a long run in a negative way. So you need to be very mindful of, you need to check whether the scheme has been into existence for 5, 10, 15 years or not. You need to be mindful of if any credit event or any default event has happened in the scheme or not, so that you will be well aware before that what can go wrong in that scheme. So these are the 5 things which I want you guys to be very clear of. You need to be very mindful of, so that you can select the right mutual fund scheme for your client. I hope I was able to simplify most of the terminologies which is going to help you in selecting the right mutual fund scheme for your client. Thank you for watching. I hope you guys got some good insight as how you are going to approach your debt scheme selection. In case you like the content, I would love you guys to hit that thumbs up button, subscribe to our channel, so that whenever we have some new content to share, you would be the first one to know. Thank you for watching, and most importantly, all those insights which I have shared with you, for that I have created a ready-made ebook which is going to help you and make you a ready reference, so that these terms are going to be making more sense to you. Do download the ebook which is available, the link for which is available in the description. It is going to help you selecting the right debt mutual fund scheme for your client.